Lucid and NIO, two major players in the electric vehicle space. But which one is the better investment right now? In today's video, we'll break down their fundamentals, key metrics, and future trends to help you make the best decision. All data and charts in this video are sourced from the website alphastockai.com, a powerful stock comparison platform packed with extensive performance data, helping you make smarter investment decisions. Let's start with a quick snapshot of both companies. Lucid is a luxury EV maker focused on high-end performance cars. Its current market cap stands at $7.29 billion with a stock price of $2.40. NIO is a Chinese EV giant with a market cap of $10.58 billion, trading at $5.21 per share. Earnings per share is a key indicator of profitability. Here's how Lucid and NIO stack up. Lucid has the EPS of -$1.25. NIO is -$1.50. Both companies are currently unprofitable. Now, let's look at their price-to-earnings ratio, which tells us how much investors are paying for every dollar of earnings. Lucid has P ratio of -1.92 and NIO is -3.47. Look at their moving averages. Both stocks are currently trading below their 50-day and 200-day moving averages, indicating bearish momentum. However, Lucid's price is closer to its moving averages, meaning a breakout could be more likely. Especially today, Lucid's stock price jumped over 11%, but since its current price is still below 50-day moving average and 50-day moving average is below 200-day moving average, that is why the trend shows downtrend sign. Now let's look at how do their history earnings and revenue stack up against expectations in recent quarters. Over the past quarters, Lucid has consistently missed EPS and revenue estimates until the recent 2 quarters. They showed improvement. Especially the most recent quarter, Lucid showed both EPS and revenue BP estimates, which explained why its price seemed bottom since its recent earning on February 25th and showed somewhat uptrend especially today. While NIO has had a mix of hits and misses on EPS in recent few quarters, showing relatively more stable financial outlook, even though it's still unprofitable. On the revenue side, NIO actual revenue has consistently exceeded estimates in recent couple of years, showing a steady increase in sales and production capacity. This has been reflected on its stock price starting to go up, especially with most Chinese stocks recently showing strong uptrend, and its earning call is approaching in next week. Now, we'll look at their analyst ratings and recommendations based on their key financial metrics. First, let's analyze the financial health of Lucid and NIO based on key metrics like return on equity, return on assets, and debt-to-equity ratio. Return on equity measures how efficiently a company uses investor funds. As you can see, both companies are struggling, but NIO's negative return on equity is much worse, meaning it's losing more money for every dollar invested. Return on assets indicates how well a company uses its assets to generate profit. Again, both are negative, but NIO is slightly better, meaning it's using its assets more efficiently than Lucid. Debt-to-equity ratio tells us how much a company relies on debt. Lucid has a stronger balance sheet with much lower debt compared to NIO. This means it is less risky in the long run, whereas NIO is heavily leveraged, which could be a concern during economic downturns. Now, let's look at valuation ratios. Are these stocks overpriced or undervalued? We have looked at their P ratio. Here are their trailing 12 months values. Price-to-book ratio. Lucid is 1.5, which is fairly valued, while NIO seems expensive relative to its book value. On the other hand, look at their price-to-sales ratio. Lucid is 9.2, which is extremely overvalued based on revenue, while NIO is trading at a reasonable price relative to its sales. Now, let's check what the analysts are saying about Lucid and NIO based on their financial metrics. As you can see, analysts are not optimistic about Lucid, with multiple strong sell ratings due to weak profitability and high valuation concerns. While NIO has similar sell ratings, it received a strong buy for its DCF valuation, meaning analysts believe it has more long-term growth potential compared to Lucid. So just from these few metrics numbers, if you're looking for short-term stability and less risk, Lucid might be a better option due to its lower debt and fairer valuation. But if you believe in long-term EV growth, NIO could be the better pick. Now let's look at analysts' forecasts for revenue, earnings, and profitability to see which company is expected to dominate the EV industry in the coming years. First, let's look at the revenue growth, which is a key indicator of a company's ability to scale and expand. Clearly, NIO is on another level when it comes to revenue, expecting to hit nearly $178 billion by 2028, compared to Lucid's $11.45 billion by 2029. While Lucid is growing fast, it's operating on a much smaller scale. Revenue is great, but what about profitability? Let's look at EBIT, EBITDA, and net income projections to see which company is expected to make money first. EBIT for Lucid is currently deep in the red and losses expected to worsen over the next few years and no signs of profitability through 2029. Then looking at NIO's EBIT, while it is still unprofitable, but losses expected to narrow. And NIO's net income is expected to turn profitable by 2028. So this is where NIO clearly has an advantage. And their EPS forecast also showed the similar trend. Lucid won't make its EPS break-even until 2029, while NIO could generate positive EPS of 1.5 and generate real earnings by 2028. If these forecasts hold true, NIO could become a much more attractive stock for long-term investors. Now forecast is clear. What about their history financial data? Let's firstly look at some financial ratios indicating their profitability in the recent 8 quarters. Lucid's net profit margin has been consistently negative, ranging from minus 521.66% to minus 169.41%. This indicates that the company is incurring significant losses relative to its revenue. In contrast, NIO's net profit margin, while also negative, ranges from minus 36.02% to minus 69.79%, showing a less severe loss relative to revenue. Lucid's gross profit margin has improved slightly over the quarters, from minus 234.95% to minus 89.04%, indicating a reduction in the cost of goods sold relative to revenue. NIO, however, maintains a positive gross profit margin, ranging from 0.99% to 10.75%, suggesting better control over production costs. How about their liquidity? There are few ratio values describing this performance. Current ratio is defined as current assets divided by current liabilities, which measures a company's ability to pay off its short-term liabilities with its short-term assets. A higher current ratio indicates good liquidity, showing that the company can easily meet its short-term obligations, which is reassuring for investors. Lucid's current ratio has averaged around 4.68 over the past 8 quarters, peaking at 7.07 in Q2 2023. This is substantially higher than NIO's average of approximately 1.14, suggesting Lucid's superior ability to meet short-term obligations. Quick ratio measures a company's ability to meet its short-term obligations with its most liquid assets. Cash ratio defined as cash and cash equivalents divided by current liabilities. It evaluates the company's ability to repay its short-term debt with cash and cash equivalents alone. A higher cash ratio suggests the company is in a good position to pay off its debts, enhancing its attractiveness to investors. Lucid's cash ratio averages 1.64, while NIO's is around 0.43. So Lucid's higher cash ratio indicates a better capacity to cover its current liabilities with cash and cash equivalents. Lucid's current ratio and cash ratios consistently outperform NIO, indicating its ability to cover short-term liabilities. However, from the operating efficiency perspectives indicated from operating cycle and cash conversion cycle, a shorter operating cycle indicates a company is quickly turning inventory into cash, which is beneficial for cash flow and financial health. Lucid's efficiency in managing its operating cycle and cash conversion cycle shows room for improvement. In contrast, NIO demonstrates a more efficient cash conversion cycle. Cash conversion cycle measures the time it takes for a company to convert its investments in inventory and other resources into cash flows from sales. The shorter cash conversion cycle is generally preferred, indicating that a company can quickly convert its inventory into cash, enhancing its liquidity and ability to fund operations. As you can see from the chart, Lucid's operating cycle averages around 162 days in the past 8 quarters, with a cash conversion cycle averaging 138 days. In contrast, NIO's operating cycle averages 78 days, with a negative cash conversion cycle of minus 53 days, indicating NIO is more efficient in converting its operations into cash. From their recent earnings, Lucid just dropped its latest earning reports on February 25th, 2025, and NIO published it on November 20th, 2024. Who performed better? Let's start with the numbers. Lucid's Q4 2024 earnings report showed significant improvements, with revenue reaching $234.5 million and deliveries up 71% year over year, totaling 10,241 units. While still unprofitable, the company managed to improve its gross margin from negative 225% in 2023 to negative 114% in 2024, signaling better cost control. Lucid also maintains a strong cash position of $6.13 billion, which will be critical for future expansion. Now, looking at NIO's report, the company generated 18.7 billion renminbi in revenue. Deliveries came in at 61,855 vehicles, maintaining its dominance in China's premium EV market. Despite a slight revenue dip year over year, NIO's vehicle margin improved to 13.1%, up from 11% the previous year. The company closed the quarter with a solid cash position of 42.2 billion renminbi, giving it the financial flexibility needed to expand globally. NIO clearly leads in revenue and deliveries, but Lucid is showing meaningful improvements in financial discipline and production efficiency. So, after analyzing their latest earnings, fundamentals, and future growth potential, where do these two EV giants stand? Lucid is making progress with improved margins, a strong cash position, and the highly anticipated Gravity SUV launch. However, leadership changes and production challenges remain key risks. On the other hand, NIO is scaling rapidly, expanding into multiple markets, and expected to turn profitable by 2028, but it carries higher debt and faces regulatory hurdles in international markets. If you're looking for short-term stability and a low-debt EV play, Lucid might be the better option. But if you believe in long-term EV growth and global expansion, NIO could be the stronger pick. Drop a comment below and let me know your pick. And if you found this analysis helpful, make sure to hit that like button, subscribe, and turn on notifications so you never miss an update on the stock market. Thanks for watching, and I'll see you in the next video.